It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at various option strategies. So without further ado, let's begin. The first strategy we'll look at is writing covered calls. To write a covered call is to sell it, but it's more than that. When you write a call, you are creating it. When you write a covered call, you create one or more contracts selling the right to buy shares that you already own. The fact you already own them is the covered part. For instance, you might own 100 shares of Microsoft. You could write a covered call, creating a contract that would give the buyer of your call the right to buy those 100 shares at a specified price sometime between now and a future date, the expiration date. By writing and then selling this call, you'd collect a premium. For instance, if you owned 100 shares of Microsoft and you wrote a January 2013 call with a $30 strike price, as of current prices, you'd collect $247, that's $247 a share, as the premium. Once you got this money, one of two things would happen. Either the call would be exercised, which would mean you'd have to sell the 100 shares at $30 a piece. Remember, that was the strike price. And that's irregardless of whatever the market price of the share was at the time. Or the second alternative is that the shares would go, or the calls would go unexercised, which means you would keep your shares and the $247 premium. Writing covered calls is a low-risk way to generate income from your stocks and a very important option strategy to understand. A much higher risk strategy is to write what are called naked calls. This means you write a call contract on shares you do not own. Let's say you wrote the same contract and sold it, as in the previous example, for 100 shares of Microsoft with a $30 strike price and a January 2013 expiration date. You'd receive the same $247. The difference is that if the call was exercised, you'd have to go out into the market and buy 100 shares. So if Microsoft's share price rose to around, say, $35 a share, you'd have to go out and buy 100 shares at $35 and then turn around and sell them for $30. This would obviously lose you $5 a share, or $500 total, since we're dealing with 100 shares. You'd still keep the $247 in premiums that you collected, if you recall, though. But what if Microsoft, instead of just going up to $35, went up to $50 per share? You'd be in a lot of trouble there. That's why writing covered calls is a much more conservative strategy than writing naked calls, which is an aggressive and risky strategy, but of course can pay off big. Another strategy is writing naked puts. This can get kind of confusing, so you're going to have to bear with me. By writing and selling a naked put, you are selling the right to sell shares of a stock at a specified price, the strike price, on or before a specified date, the expiration date. So what you're really doing is agreeing to buy those shares at the strike price from someone else. For instance, let's say Microsoft is trading at $30.70, which it was when this video was put together. But you wouldn't really mind paying $35 per share because you think it's going to go to $40. Okay, following along? Well, you could sell a naked put and collect $504. That's because the per share premium right now is $504 for that particular option. Now, if Microsoft fell to $25 or so, you can bet that that put would be exercised. And then you'd be forced to buy the 100 shares at $35 from the person that bought the put from you. Get it? It's important to have these basic concepts down before moving on to the more exotic multiple option strategies, which we're going to do in the following slides. Now we'll look at what are called collars. A collar is when you buy a put and sell a call on a stock that you own. The purpose of this strategy is to protect yourself from risk at little or no expense. For instance, imagine you own 100 shares of Nike trading at $60. You could buy a $50 strike put at $1.50 and then sell a $75 strike call at $1.10. This would result in a net cost of 40 cents per share, or $40 total. Now, if Nike falls to $45, you could exercise your put and sell your shares at $50. Your call would expire worthless. If Nike goes to $80, then the call you wrote would be exercised and you'd have to sell for $75. You'd lose out on the profits you could have had by selling at $80, but you'd still make money assuming you bought the shares for less than $75. This is how the collar can be a really low-risk strategy. The third scenario is that the stock would stay between $50 and $75 all the way to expiration, and thus the call and the put would expire worthless. You'd lose out on the $40 you spent, but that's a small price to pay for the insurance you received. We're running a little over time here, so let's take a quick look at spreads. They're different from collars because you don't have to own the underlying stock for them to make sense. There are many kinds of spreads, but since we're running out of time and really have run over time, we'll just look at debit price spread in this example. A price spread is a two-option strategy in which both options have the same expiration date but different strike prices. The two parts of a spread are either both calls or both puts, not a mix. If you were to buy a $40 strike September call at $5.50 and sell a $45 strike September call at $1.70, this would be a debit price spread. Debit, not credit, because you spent more, $550, than you received, $170. This is demonstrated in the T-chart below. We're running out of time, so I'll be really quick. Let's imagine the stock in question went to $50. The $40 strike call would have a value of $1,000 at expiration, but the $45 strike call you sold would be worth $500. Both would be exercised, which would leave you with a profit of $120 as shown. There's a lot more to price spreads as well as calendar spreads and other option strategies, but we've run out of time. Perhaps we will address these strategies in a future episode. Until then, we hope that you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.